Asia-Pacific shares plunge into bear territory amid fears over global economy. Shares in Asia-Pacific have plunged into bear market territory and wiped billions off the values of companies as one analyst warned that the losses could be a harbinger of a wholesale capitulation. After the worst day for tech stocks on Wall Street for 7 years, markets were in retreat from Sydney to Shanghai as concerns about the global economy and rising borrowing costs were compounded by local factors. In Australia, the benchmark ASX 200 was down 122 points at 5,706, a loss of 2.1%, and looks set to suffer its fifth straight day of losses. In Japan, the Nikkei was off 3.2% and has now dropped around 13% from a 27-year peak of 24,448.07 touched in early October. Related, Dow Jones falls 600 points as market volatility continues. As it happened, a broad indicator of shares in the region, the MSCI Asia Pacific Index, has now fallen 20.3% from the year-to-date high set on 29 January. Representing an official bear market. The VIX Fear Index, which measures volatility across the market, has spiked sharply this week and was up 21% overnight. We haven't thought that selling would be this steep. This sell-off makes us think the market may be set for capitulation, said Shoji Hirakawa, chief global strategist at Tokyo Research Center. And the VIX spiked to over 26. A level last seen in February. This similarity obfuscates two, related, differences. First, less enthusiasm on the part of investors to buy the dip. Second, accumulated evidence that the Fed no longer has the market's back covered as in the past. Pic.twitter.com/23W7 If China's central bank decided it had seen enough and intervened for the fifth day running by injecting 100 billion yuan, $14 billion, into open market operations. It brings the total for the past 5 days to 540 billion yuan, or $77 billion, and aims to head off a liquidity squeeze. Chinese stock markets have struggled under the weight of a slowdown in the economy and fears about U.S. tariffs on Chinese goods. The Shanghai Composite Index slumped 2.5% in the first minutes of trade before paring losses to 1.3%. In Hong Kong, the market was off 1.8%. Bad day for Aussie stocks with ASX 200 down to lowest in a year. Now on longest losing streak since September 10th. Financials have entered a bear market. #Ausbiz #Auspoll at Bloomberg Go at Markets Pic.twitter.com/5xw2IP5 chart. South Korea's stocks in bear market territory. Pic.twitter.com/1mchaos2WHPF The gloomy mood was spread across the region, with South Korea's stock market entering a bear market after growth in the third quarter came in at a lower than expected 2%. The export-driven economy is seen as a good indicator of the health of global trade, so the poor figures saw stocks on the Kospi index fall 2.4%. The US dollar continued to gain strength, heaping pressure on sterling, which fell to $1.289, the euro, down slightly at $1.14, and the Australian dollar, which was buying US 70.7c. The fear is palpable in stock markets at the moment, Greg McKenna, an independent markets strategist in Australia, said on Thursday. This could get much worse before it gets better. Collapses happen after falls. That's the danger. Thursday's nervous sell-off comes after U.S. stocks fell overnight, where a rout in technology stocks saw the largest daily decline on the Nasdaq since 2011. The falls confirmed a correction for the Nasdaq and erased the Dow and S&P 500's gains for the year. If the month ended today, it would be the worst monthly decline for the S&P 500 total return index since February 2009, minus 8.8%. $SPX Pic.twitter.com/9RWXN1K8QD Week U.S. housing data, mixed corporate earnings results, trade war fears and concerns regarding a slowing global economy all contributed to the sell-off, Sydney-based Rivkin Securities said on Thursday. Australia's financial sector was one of the worst hit. The embattled wealth management firm AMP was the worst performer on the market as its shares fell nearly 20%. Energy, resources and technology stocks were also affected as the dive continued the ASX's worst month in more than 3 years. The market is now down more than 8% for October, and 10% since August, meaning it is officially in correction territory. Faltering consumer sentiment, low wage growth and falling house prices are compounding the impact of global factors. On Thursday, householders and property developers were warned that the country's housing market should prepare for a downturn of a scale not seen for 30 years. The consultancy Ernst & Young said in a report that it does not expect a crash but said falling prices and tighter credit meant a sustained period of uncertainty, which will cloud future developments and projects. Unlike previous downturns, interest rates look set to remain low. While we don't envisage a crash, it has become much harder for home buyers and developers to secure finance, said Richard Bowman, real estate partner at Australia. Related, stock market investors are finally facing up to global turmoil. Jonathan Chan, of CMC Markets in Sydney, said Australia could benefit from further Chinese stimulus but would also feel the brunt of a US-China trade war. The aftermath of US-China trade war is slowly surfacing in the US corporate earnings reports, leading to a global risk-off tone, he said on Thursday. Investor buying in Australia may be limited but a bounce is possible if more corporations reveal a stronger sales and revenue number. This article was written by Martin Farrer, for TheGuardian.com on Thursday 25 October 2018 04.57 Europe/londonguardian.co.uk Copyright Guardian News and Media Limited 2010